Translation exposure. Translation exposure emerges on account of consolidation of financial statements of different units of a multinational company. That is, consolidation of accounts of parent company and its subsidiaries. This is done to find out the overall profitability of the company so that efforts will be directed towards profit maximization. Also, it is undertaken to evaluate the comparative performance of different subsidiaries. The consolidated figures are recorded in the home country's currency at current rate and historical rate of exchange. For example, if the parent company is located in the US and the subsidiaries are located, for example, in India, Japan and Britain, the accounts of the parent will be recorded in US dollar, while the accounts of the subsidiaries will be recorded in rupees, yen and pound respectively. All the subsidiaries' accounts figures will be converted to US dollar at historical rate and current rate of exchange. Current rate is the rate of exchange existing on the day of consolidation. Historical rate is the rate of exchange when the account was recorded. This procedure is known as translation. On account of such translation, the mismatch that exists between the translated values of assets and liabilities following exchange rate changes is known as translation exposure. For the calculation of translation loss or gain or translation exposure, we have four methods. Namely, the first one is current rate method, the second one current non-current method, the third monetary non-monetary method, and the fourth temporal method. For the first method, that is current rate method or closing rate method, all items of the income statement and balance sheet are recorded at current rate, which is also known as post-change rate. The second method, that is current non-current method, here the balance sheet items are divided into current items and non-current items. The current items will include current assets and liabilities, which will be recorded at current rate. The non-current items include fixed assets and long-term liabilities, which will be recorded at historical rate. Third type of method is monetary non-monetary method. This method divides the balance sheet items into monetary items and non-monetary items. Monetary items record all liabilities and current assets except inventory at current rate. Non-monetary items, that is inventory and fixed assets, are recorded at historical rate. The fourth method is temporal method. Here also the items are divided into monetary items and non-monetary items. Monetary items include all liabilities and current assets, including inventory if it is shown at market price, which will be recorded at current rate, and non-monetary items include inventory if it is not shown at market price and fixed assets. These items will be recorded at historical rate. Let's solve the first question on translation exposure. Referring to the question, try to tally both the sides, assets and liabilities. You will see that both the sides, assets and liabilities, are not matching. That balancing figure is from the liability side and we name it retained earnings. Draw the following table on your notebook. As you can see in the table, the first column shows the balance sheet items and the next column shows the corresponding figures in rupees. The next two columns show the historical rate of the items and the current rate of the items. The next four columns represent the four methods of calculating translation exposure. The first one, current rate method. Second one, current non-current method. Third, monetary non-monetary method. Fourth, temporal method. Solving the problem. Start by writing all items on the asset side followed by total assets. Next, write down all the items on the liabilities side. Next, write the balancing figure, retained earnings, followed by total liabilities. Next, write down translation gain loss. This refers to the translation exposure, which we will be calculating using the four methods. Write down the figures of all the items of the balance sheet. Calculate total assets. We get rupees 11,000. Our total liability should also be rupees 11,000. Just copy the same figure of total assets. Calculate the balancing figure of retained earnings, that is 11,000 minus current liabilities, long-term debt, share capital, which are all the items on the liability side. We get the difference as rupees 2,000. The translation gain loss is in terms of dollars, so we need to convert all these rupees values to dollars. Convert rupee values to dollars using historical rate at the rate of rupees 30 per US dollar, current rate at the rate of rupees 35 per US dollar. One example, the first item is current assets, rupees 2,000. To convert at historical rate, divide 2,000 by 30, we get 66.67. To convert at current rate, divide 2,000 by 35, we get 57.14. In this way, calculate all the figures except total assets, retained earnings, and total liabilities. Now calculate the total assets under historical rate column. We get 366.67. Similarly, calculate total assets under current rate column. We get 314.29. Write both the totals for total liabilities under both the columns, that is 366.67 and 314.29. Calculate retained earnings, that is the balancing figure. We get 66.66 and 57.15. Using the four methods, we will now calculate the translation gain loss. The first one using current rate method. Copy the entire column of current rate figures in the current rate method. We don't have to take much efforts since we already have calculated the figures with the current rate of rupees 35 per dollar. While solving the problems, refer to the theory of methods at the same time. Using current non-current method, this is the second method. The current assets and liabilities are recorded at the current rate. These are current items. Fixed assets and long-term liabilities are recorded at historical rate. These are non-current items. In this balance sheet, our current items are current assets, inventory, and current liabilities. All these items will be recorded at current rate. Next, our non-current items are fixed assets, goodwill, long-term debt, and share capital. Record these items at historical rate. Next, calculate total assets, that is 338.09. Record the same amount, that is 338.09 under total liabilities. Calculate a balancing figure of retained earnings, that is 57.13. The third method is monetary non-monetary method. The balance sheet items are divided into two categories. First one, monetary items. Now these are items which consist of all liabilities and current assets except inventories, and these items are recorded at current rate. The second category is non-monetary items, that is inventory and fixed assets, and these are recorded at historical rate. In the balance sheet, the monetary items are current assets, current liabilities, long-term debt, and share capital. These items will be recorded at current rate. The second category, that is non-monetary items, are inventory, fixed assets, and goodwill. These items will be recorded at historical rate. Next, calculate the total assets, that is 357.13. Next, record the same figure of 357.13 under total liabilities. Calculate the balancing figure, that is retained earnings, which is 99.99. The fourth method is temporal method. It is similar to monetary non-monetary method, but the only difference is that inventories at market value only are recorded at current rate. If inventories are not shown at market price, then they will be recorded at historical rate. So the monetary items will consist of all liabilities and current assets including inventory if it is shown at market price. These items will be recorded at current rate. The second category of non-monetary items will consist of inventory if it is not shown at market value and all fixed assets. These items will be recorded at historical rate. Next, calculate total assets, that is 338.09. Record the same amount of 338.09 under total liabilities. Calculate a balancing figure of retained earnings, that is 80.95. Now we will calculate translation loss gain using the four methods. The translation exposure is a difference between the retained earnings calculated under a specific method and the retained earnings at historical rate. First, under current rate method, the retained earnings are 57.15. The retained earnings at historical rate are 66.66. The difference is minus 9.51. Therefore, the translation gain loss under current rate method is minus 9.51. The second method, that is current non-current method. The retained earnings are 57.13. The retained earnings at historical rate are 66.66. The difference is minus 9.53. Therefore, the translation gain loss under current non-current method is minus 9.53. Third, under monetary non-monetary method, the retained earnings are 99.99, while the retained earnings at historical rate are 66.66. The translation gain or loss under monetary non-monetary method is plus 33.33. This is translation gain. Fourth, under temporal method, the retained earnings are 80.95, while the retained earnings at historical rate are 66.66. Therefore, the translation gain or loss under temporal method is 14.29. It is found that the current and current non-current methods yield translation loss, while the other two methods yield translation gain on account of rupee depreciation. That is, we can see that the dollar has appreciated from rupees 30 to 35. This means that rupee has depreciated. Problem 2. In this problem, both the sides, assets and liabilities are tallying at rupees 2,400. We also have retained earnings on the liability side. The method of solving problem 2 is same as solving problem 1. So do not get confused with the retained earnings figure. It may appear or it may not appear in the question. In case of current method, all balance sheet items will be recorded at current rate. In case of current non-current method, the current items will be current assets and liabilities, that is cash, marketable securities, debtors, inventory and current liabilities. The non-current items will be fixed assets and long-term liabilities, that is land and building, plant and machinery, furniture and fixtures, share capital and bonds. In case of monetary non-monetary method, the monetary items will be all liabilities and current assets except inventories, that is cash, marketable securities, debtors, current liabilities, share capital and bonds. The non-monetary items will be inventory and fixed assets, that is inventory, land and building, plant and machinery and furniture and fixtures. In case of temporal method, the monetary items will be all liabilities and current assets including inventory if it is shown at market price. In this problem, it is not specified whether cost price or market price, hence assume that inventory is shown at market price. Therefore, the monetary items will be cash, marketable securities, debtors, inventory, current liabilities, share capital and bonds. The non-monetary items will be land and building, plant and machinery and furniture and fixtures. Here is the complete solution of problem 2.